Hello, good morning. I am Avnish Jain. Welcome to Canara Robeco monthly data outlook. As usual, we'll start with the global events. Global growth continues to be resilient with inflation moderating, though the moderation of inflation has slowed down considerably in the past few readings. In US, inflation has been mostly static for the last 2 months, creating some difficulties for the US Federal Reserve to go ahead with a rate easing in the immediate policy, which is there next week. US growth continues to remain steady and strong, though the inflation has stopped slowing down from the levels which was reached in December last year. Now it is mostly moving sideways, giving some discomfort to the US Federal Reserve officials on the proposed rate cut cycle, which is likely to start as soon as inflation eases to a level where the US Fed is comfortable on the trajectory of inflation to reach 2% in the long term. US rates continue to remain volatile, moving both ways. Around 4%, 10-year centric rates have moved around 4%, and markets have been more subdued, awaiting concrete action from the central bankers. US Federal Reserve meeting is scheduled for next week, where the rates are likely to remain status quo, while the members may point out that they will continue to be data driven and depend on incoming data on growth and inflation to determine the future course of action. Likely rate cut is expected around June of this year, where people expect that inflation would have fallen enough from the current level to give comfort to the US federal officials to start the rate easing policy. In December, there was a lot of expectation that the US Fed will ease rates by almost 120 to 150 basis points. But now that has been dialed back. Rate easing is expected to be now about 75 to 100 basis in 2024. Coming to India, India continues to remain a bright spot in the global economy. Growth continues to confound skeptics. It was a big surprise when we saw the GDP growth for third quarter of FY 23-24. It came at a big number of 8.4% versus expectation of 6.6%, almost 200 basis points above market expectations. Clearly, Indian growth continues to remain resilient in spite of global headwinds. Inflation also surprisingly continues to remain moderate. While in the last two reading, inflation has remained at 5.1%, the core inflation continues to provide comfort to the RBI, where it is in the range of 3.5 to 3.7% in the past few readings, which is below 4% target of RBI. However, RBI has been very adamant that they want to see inflation move towards the 4% medium-term target over the next few months. Considering that growth continues to remain extremely good and strong, RBI has the extra luxury of keeping rates in the status quo mode, and RBI has been in pause for the full year of 2023-24. They went into pause in April, and February policy also they were in a pause mode. Also, there has been no change in stance of the policy as well. Lately, we have seen RBI release bit of liquidity, partly due to government spending and partly due to some forex transactions. But from that angle, RBI is now okay with releasing liquidity into the system as inflation is trending lower as per their forecast. So in the near term, we don't expect RBI to move on rates anytime soon. Earliest, probably we could look at August policy move or in the second half of 2025. This will be only after Fed cuts rates, probably as expected in June, then probably RBI could follow up with a small rate cut in either August or in October policy. Overall, this rate cut cycle for RBI, at least for 2025, is not going to be too much. We expect approximately 50 basis rate cut by RBI in FY 24-25. Unless growth suddenly surprises on the downside, which at this juncture doesn't look a base case for us. Coming to rates, because of expectation of no rate cut from RBI, the front end of the curve has been holding up. We have seen drifting down of rates in the long term. 10-year yield recently touched 7%. with the 30-year bond at around 710. And if you look at 1-year T-bill is at around 7.15. So curve is practically flat. And the reason being, as we already discussed, is that since there are no rate cut expectations, the front end curve won't react too much. RBI has released liquidity and overnight rate has been now below or near 6.5%, which is the repo rate for some time now. So we have seen some movement in the short-term rates, but they continue to remain elevated as compared to the longer-term rates. One reason for the longer-term rates to drift lower is FII flows. The foreign institution flows in the past few months have been spectacular. If we look at first 2 months of 2024, we have already got $6.2 billion of inflows. And last year, we received almost $8.6 billion, that is in calendar 2023. So putting these two together, we got almost $15 billion of inflow in the last 1.5 years. The primary reason for this inflows is that India government bonds got included in the JP Morgan Emerging Bond Index, which is likely to lead to inflows of about 20 to 25 billion in FY25. And the inflows are supposed to start from June of 24, or the inclusion will start from June of 24. So one could presume that these inflows which we are seeing is active flows front-running passive flows which are likely to come from June onwards. This also provides lots of positivity to the markets. One, because inflows will continue to support bond markets and any sell-offs for whatever reason will be supported. Second, we are already looking at a rate easing cycle to start sooner or later. Most of the central banks across the world have somewhat declared that the rate hiking cycle is over, as with RBI, because RBI has been in pause mode for last 1 year. So clearly the next step is likely to be a rate easing cycle. Question is obviously when they will start. That is dictated by incoming data and how fast inflation falls in the next few months. As expected, US Federal Reserve could start cutting in June and RBI could follow in the next few policies. These two factors will continue to drive bond markets in this coming financial year FY 2025. And this gives an opportunity for investors to invest in bond funds and take advantage of the likely movements in yields going down, which could give better returns over 1 year to 2 year periods than normal returns. For investors, obviously the question remains where to invest. We continue to believe that the short end of the curve is still elevated, and 2 to 3 years or 2 to 4 years papers are where we find good value. From that perspective, investment in banking and PSU debt kind of funds is a good option for investors. For investors who want to play the duration and the likely drop in yields over next 1 year, can invest in gilt funds or dynamic bond funds or income funds, where duration is right now probably for most of the funds on the higher side, and they can take advantage of fallen yields, which is likely to generate additional capital gains over next 1 year to 2 years. As usual, investors should look at their risk profile and their investment maturity when looking to invest in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.